Hey everyone, and welcome. Today, we're diving deep into Grab, Southeast Asia's super app. And really, the big question on everyone's mind is this. Is this a misunderstood tech giant that's just about to take off? Or are the risks simply too high? Well, we're going to unpack the entire investment case right now. To really get Grab, you have to get its founder, Anthony Tan. This isn't just some corporate story. It's a story of incredible personal sacrifice. He literally chose his vision for this company over his family's business, a decision that created a lasting rift with his own father. That kind of conviction, that's just baked right into the company's DNA. Okay, so here's how we're going to break this down. We're going to look at Grab's journey from a simple safety app to a super app. We'll analyze its financial turning point, explore some of those high-margin opportunities, and of course, we have to weigh the risks. And finally, we'll tackle the big question, what is this thing actually worth? So let's start at the beginning. How did Grab get to where it is today? Now you might think, oh, they just copied Uber, right? But that's not the whole story. The reality is it started by solving a really fundamental, very local problem, safety.
Yeah, and this timeline really shows you that evolution. It was so calculated. It started back in 2012 as MyTeksi, just focused on making taxis safe. Then, boom, rapid expansion. But the 2016 launch of GrabPay, wow, that was the real masterstroke. It basically laid the tracks for everything that came next. And the checkmate move? That was acquiring Uber's entire Southeast Asian operation in 2018. That move effectively ended the ride-hailing wars in the region.
Okay, so that brings us to the core argument for why we're even talking about Grab right now. The thesis isn't about what Grab was, but what it's becoming. It's all about this critical turning point, this inflection point in their financial story.
And this slide? This just nails it. It's the whole story in one picture. For years, Grab was all about the classic tech playbook. Burn cash, grow, grow, grow. Kind of like an early Amazon or Uber. The entire bet here is that the left side, that's the past. And the company is making this hard pivot to the right side, to sustainable profitability. And the argument isn't that this is some 5-year plan. It's that it is happening right now. So let's just boil this down. What's the core thesis here? You've got a dominant player in a huge growing market. Nearly a third of its value, it's just cash sitting in the bank, which acts as a nice safety net. And its profitability isn't just getting better, it's accelerating and fast. For an investor, this creates what they call an asymmetric opportunity, right? The potential upside just looks a whole lot bigger than the potential downside.
But here's the thing. The real long-term story, the one that gets investors really excited, isn't just about rides and food delivery. It's about building these brand new, high-margin businesses right on top of that massive network they've already built.
Okay, check out this donut chart. This shows the advertising piece of the puzzle, and it's wild. Grab has 6 million merchants, but only 3% are actually paying to advertise. That's like if Google only had 3% of businesses using Google Ads. That huge untapped 97%, well, that's a massive runway for some seriously high-margin revenue.
And that synergy gets even crazier when you look at financial services. The COO basically says their cost to get a new banking customer is almost zero. They're not out there spending millions on ads to find new customers. No, they're just converting the people who are already using their app every single day. That is a huge advantage when you're trying to build a profitable digital bank for the region.
So you take all of that, the scale, the cash, this whole ecosystem, and what you get is a really powerful competitive advantage, what investors love to call a moat, right across one of the fastest growing regions in the world. In the competitive landscape, it kind of looks like what you see here. Grab is the big, well-funded skyscraper. It's got the brand, it's got a massive $7.6 billion war chest. Local competitors, they're scrappy, but they just can't compete on capital. They literally can't afford to burn money on subsidies and marketing the way Grab can.
And Grab's management, they're not shy about this. They're very clear on their strategy. The CFO basically said, look, competitors will come and go, we're not worried about them. Their focus is on using their scale to make sure their prices are good and their selection is the best, because they believe that's the key to keep growing their user base.
Okay, but it's not all sunshine and roses, right? No investment is. A complete analysis means we have to look at the other side of the coin, the bear case. What are the big things that could totally derail this growth story?
So what are those key concerns? What are the things that keep investors up at night when they think about Grab? The source material lays out a few big ones that you really have to understand.
All right, so the risks really fall into a few key buckets. First, you've got macroeconomics. If Southeast Asia hits a recession, consumer spending is going to get hit hard. Second, regulation. You never know when a government might change labor laws or hit them with antitrust stuff, and that could completely upend their model. And finally, there's execution risk. As they jump headfirst into banking, they're building up this huge loan book that's never really been stress tested by a big downturn. If loan defaults start to spike, well, that could get very painful very fast.
Okay, so after all that, let's try to put it all together and talk about valuation. How does the author of our source material think about this, and what do the numbers suggest for the future?
When you start to look at Grab's valuation, you absolutely have to start with its balance sheet. The company is sitting on $7.6 billion in cash. Just let that sink in for a second. At its current valuation, that means almost a quarter of what you're paying for a share of Grab is just for the cash on its books. For a lot of investors, that's a pretty significant safety cushion.
So, the author lays out this kind of hypothetical path to a $10 stock price. Now look, this isn't a guarantee, it's not a prediction, it's a model to show you the potential. It basically assumes they keep growing their earnings super fast, that the market gives them a valuation multiple kind of like their peers, think Uber, and that they keep adding to that big cash pile. If, and it's a big if, but if they can pull that off, the math suggests the stock could more than double from where it is today.
And you know, it's not just us or some analysts noticing this. When a legendary value investor like Howard Marks, a guy who is famously skeptical of these high-growth tech stories, starts buying up millions and millions of shares, well, that makes Wall Street sit up and pay attention. It's a huge signal that maybe, just maybe, the story is changing.
So, what's the bottom line here? What's the big takeaway? After all those years of burning cash just to win the market, it really does seem like the pieces for profitability are finally falling into place. So the question for you, for any investor, is pretty simple. Do you believe management can execute this final turn? Can they actually convert all that market dominance into real, sustainable profit? That right there is the multi-billion-dollar question.